wonderful. We'll get started here, and we'll let people trail in as we get things going. So great to see everyone on the call today. I'm super excited to be hosting this first case study where we're going to take what we thought to be true and walk through it and really come out with some pretty interesting ahas and get to gig out on some numbers, analysis, and all that good stuff. So thanks for coming to the call. A couple housekeeping items. We want to make sure that this is an interactive process, that if you have questions, put them in the chat box. Feel free to raise your hand. We want to make sure that we get questions answered, people can chime in, but we make this packed full of just good information, questions, and takeaways from this case study. So let's go ahead and get started. I'd like to introduce Travis Medley. He's a past client of one thing, but of many others, a current client, a friend, a mentor, and also a CEO of Talent Zoke, one of the fastest growing staffing and recruiting companies here in Southern California. So Travis, thank you.
Oh, thanks, Nick. Good to be here.
Yeah,
this has been a long time coming.
It has been a long time coming. We had to wait a while to see the positions play out. So we're excited to go over it. So with that being said, let me get into the overview. So what we're going to do today is we're going to review Travis's purchase of a condo here in San Diego. This happened back in 2014. We're going to look at the sale of that and also dive into what was kind of the decision conversation, what was being thought as far as why he would do something, why he wouldn't, as far as a 1031 exchange, reinvesting, and really looking for opportunities to generate better income. So lastly, we'll compare local versus out of state, and specifically the San Diego condo versus the Alabama properties. So without further ado, let's go ahead and jump into the overview of the purchase. And like I said, if you have any questions, perfect. Just go ahead and put them in the chat box or raise your hand. So Travis, we had an opportunity to work together in purchasing this beautiful condo in Mission Gorge. And Travis was able to purchase the property for $264,000, put down 20%. And a really important note, he did get a 15-year conventional. So the point I want to make about that is we're going to be showing what is a negative cash flow. And yet, if we were to replicate the same loan in a 30-year term, the outcome would still have been about roughly a break even.
Right.
So you understand we're trying to help convey a bigger picture here as far as the value of leveraging, reinvesting, and what that can mean for you big picture. So with that being said, Travis, kind of just walk us through, like, when you were starting this process of purchasing a condo or a rental property, what was kind of the main goal?
Yeah, I mean, we were looking just for a flat out place to invest some money, not a ton of money, but we had about $55,000, and we were just looking at, do we put this in the stock market? Do we diversify out of that a little bit? And I think, as you and I had talked on a couple of occasions, my grandparents and parents have always had rental properties, so that seemed like the natural way to go and sort of replicate what I'd seen done since I was a kid and what they were doing. It all ended up a little bit differently, and actually things that I think they've learned as a result of this entire process over the last few years. But that was sort of the genesis or the thought behind getting started on a piece of property.
Perfect. Makes sense. Pretty straightforward. So we're going to jump into some of the financials. So I want to acknowledge that some of the slides got out of whack here, so I do apologize. What I'll point out for you is a snapshot of the financials, which is the rental rate was $1,850 at the time. He was paying a management fee of $148, HOA of $325, and then the full-in mortgage. So principal, interest, taxes, and insurance, right? Not just principal and interest. was 1878. So what you don't see below there is the monthly net cash flow was negative $500 a month.
Yep.
And the annual, of course, is $6,000 negative. Now, again, preface, a 30-year loan, this would have been roughly a break even. But either way, we're going to show you that the difference, of course, between this and the other portfolio, regardless of give and take, is still going to sizably outperform from a cash flow standpoint. So with that in mind, Travis, I think being negative was probably a motivation, but overall, like
Sure.
what kind of caused you to take a step back and look at your property and start to consider options?
The negative cash flow absolutely factored into that, although that was sort of a self-inflicted wound, right, by doing a 15-year conventional. So we knew what we were getting into. But one of the biggest things that we'd looked at is the property was aging. It was getting close to being about 20 years old. And my wife and I were having some discussions about whether the property needed to be updated for renters. And as we looked at what it might cost to sort of bring a lot of the interior current and what we would get out of that from a rental standpoint, those numbers just didn't calculate out very well, because we were looking at something that might have cost $20,000 or $30,000, and we, at the time, and working with our rental management company, thought that we could only get maybe another 100 or 150 a month in rent. So that didn't seem like a really good investment opportunity or a smart financial play. And that sort of caused us to say, gee, you know, we've had some appreciation in here. We've had some pretty good principal pay down. Does it make sense to sort of leverage this into another property or properties? And what might those options look like? But it was really as simple as losing money, and do we really want to invest money in updating it when the payoff doesn't seem like it's going to be very strong?
So it sounds like it was pretty clear that a decision to act and do something was on the agenda.
Yes.
So now how did we arrive at getting information and finding out what opportunities were available to reinvest into?
Well, so there are a couple things I think that stuck out for us. So although this property was in San Diego and we purchased this one, you'd obviously helped us find it, but it already had a renter in it, so that was perfect for us. It was close by, so we thought, of course, that we might manage it, and we kept the management responsibilities for the initial renter that was there. But once that person moved out about a year after purchase, and we started working with a rental management company, we found that we literally did not go back to that property for the 5 years between when that ended and when we sold it. And so the idea became larger of, well, hey, even though we had the comfort of knowing it's 20 minutes down the road, it really didn't make any difference. The rental management company handled everything. We were very hands off. And that gave us the idea that we might be able to replicate something similar, and that perhaps anywhere in the country would be fine. So it just sort of, the idea grew over the course of multiple months. And I mean, I don't know how many hours of discussions with you about what that might look like or what would make sense and if this could all work out.
Well, that's perfect, because one of the things I did hear there was by not managing it yourself, you realize you didn't have to actively or physically have a certain geographic proximity to it or have a concern, right? You had the right people to take care of it, which then opened up the idea of expanding the borders, which naturally opens up a whole nother bag of opportunity, but also a lot of information and not knowing necessarily where to go. So
that's absolutely. And I think even there was just a passing comment my dad had made when we were sort of working through all of this, which was that in good markets and bad markets, rents don't go down. And this is him speaking of 30 years of experience doing this. And although he had just said it in passing, it made the idea really interesting and perhaps even a lot more palatable to look at an area that maybe we weren't familiar with. San Diego was easy because there was a lot of comfort, not just because the property was down the street, but we felt like we understood the market. But that kind of comment and some follow-up research made us comfortable with the concept that maybe it could work anywhere, and our market knowledge really wasn't all that big of a factor in this kind of investment.
It wasn't a factor yet. You could find people that could give you good information to make
Oh yeah,
informed decisions, which is something I'm going to harp on a lot, right? Which is making sure you're working with the right people who can give you good information so you can make educated decisions about what you'll do. So now the interesting thing is, so how did we get into Alabama from San Diego? So like, first off, what areas were you considering? Because it didn't start with Alabama, right? It was just a process.
yeah. So funny enough, I happened to be on a plane to Alabama when I was having this discussion with my dad, but those are sort of unrelated. But we were visiting my grandfather, who's in his early 90s, and again has had rental properties for as long as I've been alive. And one of the things that he had talked about was this concept of getting 1% of your rent, 1% of the purchase price being the rent. And in my mind, going, that never happens, right? I mean, that we weren't even close to that with the condo here in San Diego, but it started making me wonder whether that existed. And so started literally just doing Google searches where comparing rents to purchase prices, and settled, and the same places kept coming up over and over. So we looked at quite a few, and that included Huntsville, Alabama, of course, where we ended up with quite a few properties, but we looked at Orlando, the greater Phoenix area. There are some places in Ohio that popped up, and really with you'd introduced me to realtors in I think 3 different markets that we sort of honed down our search. And once we really started sharpening our pencils and looking at things like what the insurance costs are in Florida, or what property taxes were in some of the other states, it really whittled down to Huntsville seemed to just have the best possible cash flow and best return on investment for reinvesting that money.
Yeah, well, I think that's a really important part, is that as you're looking and expanding your borders and going to other states, areas, there's going to be the same operating expenses, right? Same type of top-down report, and yet what you'll pay for each respective line item might differ, right? So like
Wildly.
I remember looking at some of the deals with you in Orlando and talking to Jackie out there, and
Yep.
it was, hey, depending on where the area is, insurance can vary anywhere from $1,000 to $4,000 a year. And I'm like, great. Well, it's hard to make a decision if you don't know what it's going to be, and it's substantially higher than what you would otherwise pay elsewhere. So it's kind of figuring out what the offsets are, right? What's the higher rent, but then you have higher cost. So just figuring out what the sweet spot was, and Huntsville provided that kind of right ratios and right numbers that it kind of spit out and said, hey, this makes the most profitable sense from a cash flow.
Absolutely. And to be fair, right? I mean, I think I looked really seriously at 3 or 4 markets. There's hundreds of markets in the US. So I would not be the one to say that Huntsville was the only or the best, but it was really good. It ticked all the boxes. I like the idea of ending up with 3 properties instead of 1. And the way that it all worked out, I mean, I don't want to dig into the math too far ahead of you, but ultimately from a cash flow standpoint, we're break even, if not a little positive, if 2 out of the 3 of them are rented. So that took a lot of pressure off, again, of not being familiar with the market, but going, look, if 2 out of 3 of these things can stay rented, great. Or push comes to shove, we could be 20 or 30% below market on the rental side, still be cash flow positive, all of which was better than what we were experiencing in San Diego, whether it was, at a break even or a loss because of the loan choice.
Perfect. So we already jumped a little bit into that. We'll talk about the sale overview, right? So you can get a sense of, okay, what was the reinvestment available? So quick hits sold for $417,500, owned it for just under 6 years. So Travis put 20% in, right? $52,800, and pulled out $255,187. So almost a 400% plus cash on cash from an equity play. So that certainly wasn't necessarily a negative thing, Travis, would you say?
No, not at all. But if only I'd held another year, Nick. No, not really. We'll get to that.
Well, yeah, that's the way we both felt. To be honest, we thought, man, wow. We looked back at the numbers again and it went up sizably. So that's a really good lesson that we're going to go over and learn. So outside of that, we got this sold. Now I want to jump to, we already talked about the, reinvesting locally versus out of state.
Yep.
So we'll skip through this one and we'll jump right into the reinvestment side. So this is a lot of numbers and stuff on the slide here. We'll break this down further. I just wanted to provide a quick visual on one page to show you the 3 properties that were reinvested into. So you can get a sense of the purchase prices all being in the mid to high 200s, 25% for the down payments, and then the gross rents. So in general, one of the things, Travis, I wanted to just touch on was just your observation of having bought one, then buying another. Just kind of quickly walk us through that process of learning about the market and then what that did for you on each respective purchase thereafter.
Absolutely. Well, I think, like a kid in a candy store, right? One, we had this reinvestment restriction where we really had to get a move on in making sure that we found the next properties that we were looking at. And so as I would find ones that sort of ticked the boxes I was looking for, I tended to move really quickly. But there were 2 key things that I think, Nick, you helped a lot with in this whole process, which one was you introduced me to a great realtor out there who was terrific. But secondly, that realtor introduced me to a management company. And so we took all of these purchases with using both of those resources where we would talk to the realtor and say, hey, what can we get this for? What do you think it could rent for? And then independently, we would verify that information with the person who would actually be responsible for renting it. And as a result of it, we actually bought all 3 of those properties sight unseen. I've not been to Alabama since we made any of the purchases. I've never seen the properties. They offered to do, video walkthroughs or FaceTime, but it didn't. In the end, we were able to treat it like an investment because of our experience in San Diego, and it just didn't matter if it was clean, if it was upgraded appropriately, if it would be a nice place for people to live, and the property manager was comfortable that he could rent it out for the right rates, which were right in line. They're $5 less than what we had targeted. Then we were pretty happy with it. And with one small exception with new construction, everything else was leased very quickly. I mean, I think inside of 30 or 40 days from the close of escrow. So it all moved really quick.
Perfect. Well, I wanted to also just touch on the totals here. I figured 4 columns of data might have been overwhelming. So I'll just give you 3 and I'll tell you the 4th one. So the total gross purchase on the left-hand side for all 3 of these is $787,000. So we sold the 417.5. We 1031 exchange reinvested into 787. So a couple things that are important about that. We leveraged up, right? So we got more debt to help leverage those purchases. We stepped up the depreciation table, right?
Yes.
So we have increased our write-offs to offset the rental income because we went from 417 to 787. Next, we put a total of 196,750, which there was some additional for closing costs, but Travis actually ended up where he had money he took out because he didn't have anywhere else to put it or wasn't planned to have that. So you bought 3 properties that you leveraged from one condo and you actually got money out from the process.
Yeah, I think we ended up with about $30,000 in an overrun that we were surprised that we ended up with as closely as we tried to get all of this whittled down the right way. But it means that we got the vast majority of our initial investment back, plus ended up with 3 homes in the greater Huntsville area.
And one thing I want to point out from a numbers standpoint, so if you did, let's just say Travis did get his 52,000 back. In theory, a dollar you get is 100%. because you have no money actually invested of your money.
Right.
It's just the leverage money. So
Yep.
that's a key thing right there. Lastly, the total gross rent. So Travis, as a reminder, was renting out the condo for $1,850. The total gross rents of these three is $5,785 a month. So again, I want to apologize. The next slide, the formatting appears to be a little thrown off. So let me walk you through this. So rental rate, I just bundled all three of them together for the Alabama. Management at 10%, the mortgage payment, and the maintenance. So in total, we ended up with a net cash flow on this of, I believe it's $1,971 a month.
Yep, right in that ballpark.
Which then equated to roughly about $23,000 a year. So just want to sit on that for a minute. So we went from negative $6,000 a year, or if we're doing a 30-year to make it apples to apples, break even, to let's call it $24,000 a year. Does anyone have any problem with putting 24,000 extra dollars in your bank account? Let me know. I can help you with that problem. So you can, as I hope and trust people are starting to see here, and this is going to continue to get even more substantial as we play this position out, but the benefit and the value that can come with checking your position and then re-leveraging it up through using 1031 exchanges. All right.
And one thing, if I could add on that too,
Yeah.
when we were looking at sort of breaking down what the property, the boxes we were looking to tick, we wanted a house that was less than 5 years old, because we didn't want to deal with what we were facing with the condo, the idea that we might need to put some money into it or upgrade it. And then just pure cash flow from that standpoint. So if it looked good to us for that reason, the property manager and the realtor both signed off on it, we were good to go, and signed everything from the dining room table here in San Diego. And again, haven't seen those properties, but trust that they're in good hands, and the rental income still comes in every month.
And again, though, you couldn't have that trust if you didn't have the right people.
Absolutely.
Oh.
And actually, I mean, when you talk about that, that's a lot of the reason why, even once we were looking at multiple markets simultaneously. It was very possible we might have ended up with one or two in Huntsville and one in the Mesa or Phoenix area. But what it came down to is we were so happy with Rob and Dan out in Alabama that it was too easy to continue working with them rather than trying to hope that we got just as lucky with other relationships in other markets.
Thanks for speaking to that, because that's important.
Yeah, they're great.
This slide's awesome, right? So this just gives us a quick snapshot of what happened with the condo position since it was sold until now, and what happened with the Alabama rentals since they were purchased until now. So we're trying to provide you a snapshot of apples to apples in both positions. So condo went up. Hey, it had a phenomenal equity increase during that time period, up to 575. And this was kind of a moment where I wanted to point out where I was, looking at Travis like, well, hold on a second. This story might not, I'm not sure if it makes sense still as far as what we're trying to convey here. And yet then we looked at the power of leveraging because of the 3 properties versus 1. What we realize is that actually he did even better in Alabama, right? He went from what would have been 157,500 and realized 263,000 in the Alabama positions. So the appreciation rate, yes, it was lower than the Mission Gorge, and yet because he leveraged up into multiple, it was okay because the rate could be lower and still have a larger equity position. So that was a really big, that was a big aha, because how many times do we hear about, investing for cash flow versus equity. And I can tell you right now, like having the bias of California being as an appreciation state, Alabama is a cash flow state. And so it's like, well, we started to unwind that and recognize they're not, unique to each other, right? They can be both accomplished, and they can all be accomplished in different markets outside of what's deemed a appreciation market if you're using the right strategy to accomplish it. So does anyone have any questions on this slide or anything that in general that we've spoken to? Because I also want to acknowledge I'm excited about this stuff. I'm nerding out about the numbers. But yeah, if any, I can speak to anything, please do put a note there in the chat box. Okay, Jeremy, any thoughts on doing a cash out refinance and buying more? Absolutely. That's something that I've also been doing, and yet that conversation's changing slightly because we have borrowing costs that have gone up almost twofold now, where we were getting rates around 3% in December, and now we're looking at rates of 6%. So definitely a consideration. But if I'm being frank, I like this idea of Travis didn't really have to put any time or money into the properties. Now, of course, he had to put, for full transparency, he had to put some paint and some things, a couple thousand into some of these rentals.
Just into one of them, into the first one.
Okay.
And then after we learned that one, we started looking for things that didn't need to be done, and it worked out just fine.
So the answer is yes. You can do a cash out refinance, reinvest the money into another one. You can buy right, let the market right appreciate, realize the equity at a later point as far as a cash out, or 1031 again. But either way, there's no wrong way to do it. As long as you're in the game, what we recognize is you're still going to have a positive outcome if you're in this game and you're consistent with it. All right, cool. So sorry for all the numbers, guys. I know it's a lot going on here, but I was super excited about this because what we're able to do is I took the current rents of the Alabama properties. I got an updated rental rate for the Mission Gorge one, and I played out a hold scenario. So they're apples to apples for the next 30 years.
And if I recall, Nick, the increased rent for the San Diego property was pretty significant.
It was, yeah. We went from
like 40% or 50%.
Yeah, when Travis had sold the condo, I believe the rents were about $19.95 or close there too. Now they're about $2,700, $2,800. So he had a really, well, he didn't have, someone else realized an increase of $800 in rent. And yet, even with that, even putting that increase in there, let's walk through these positions. So essentially at year 10, right? The annual net cash flow. So the Mission Gorge condo would be generating $14,241. The 3 Alabamas, $36,374. So again, that's right. Unless don't know how to do math, I'm pretty sure that's, yeah, more than double, right? So we're still positive in that regard. And as we continue to go down, we see it kind of level out a little bit here in the middle. And then by year 30, we're back to a $33,000 difference between the income realized on the 3 versus the 1. So check, we're winning in the cash flow conversation, right? Now, 10 years from now, 20 years from now, 30 years from now. Property value. This is where it really gets interesting. Really interesting. Like, 1.5 interesting $1 million. Property value. Now, both of these are growing at the same appreciation rates, rental rates. So we're keeping them apples to apples. Property value between the two, 10 years from now, I'm at 851 if I stayed in my Mission Gorge condo. Alabama, I'm at 1.554. Now, even if we're off on these by a little bit, this is the conversation me and Travis had, right? Which is like,
yeah,
hey, even if we try to throw as much pessimism as possible at the Alabama scenario, as much optimism as possible at the Mission Gorge, the net outcome still ends up, without question, affirming the Alabama portfolio. So let's just jump to year 30. We've got in 2052, we've got a $1.8 million 2-bedroom condo in San Diego, and we've got $3.4 million value for the 3 rentals in Alabama. And so $1.5 million plus dollars in additional equity realized for the 3 Alabama properties. I mean, that's a big number. Travis, what were kind of some of your takeaways from this?
I mean, I think I had the same bias you did coming into it. And in fact, this has been a long-standing debate with my dad, who most of his real estate is in California, and moving it out of there, and the idea that you would lose out on appreciation. But even as we'd looked through these numbers or what had happened in the past, 16 months since we sold, and I think the idea was that we found that even if things appreciate at half the rate, we're still in really good shape, not to mention the cash flow differential, which becomes hugely significant in all of this. So there were a lot of things that I was surprised. I actually, when you first told me what the Mission Gorge condo was worth, I didn't think that we had made a mistake, but thought that, wow, okay, this looks a whole lot different than I thought it does, until we had Rob pull what he thinks were conservative numbers for Alabama. These weren't pie in the sky ones, but based on actual sales and on the bottom of the ranges that he gave. And all of a sudden, we were real happy with the way things stacked up, because I think our equity position was 50% higher, even if the percentage was a little lower, but who cares?
Right. I think that's the overwhelming takeaway from this is no matter how much we tried to disprove it or disqualify it,
right,
or minimize it, it was still a very obvious outcome and result, which is one of my big takeaways is the cost of doing nothing. Well, in this case, the cost of doing nothing is $30,000 a year in income and $1.5 million in equity. So that was one of the overwhelming takeaways from that. Now we'll jump into that more here, but anyone have any questions about this information on the chart here, the grid? Christine, looks like you asked, what if the upfront investment isn't the same? Not placing 20% for someone that has a smaller budget, does it still make sense? So I want to make sure, Christina, what you're asking essentially is, does it still make sense to invest in general, or is it the positions as far as placing one 20% down versus a different percentage lower on another one? I want to make sure I have that right, but let me just answer in saying yes. The answer is yes. The answer is that if you can leverage, and you can even doing it in a more marginal manner and still make the numbers work, absolutely. Leverage is key here. Leverage is supposed to be in debt, right? Leverage debt, same thing. It's supposed to be something that you can use work for you, not against you, right? I know there's a lot of people that think of debt and immediately think of negative implications of having that, or the concerns or the risk associated with it. When it's leveraged in the right way with the right strategy and the information behind it, right? There's a lot of value and wealth. I mean, this is generational wealth. This is not even about Travis anymore. This is about Travis's kids, Travis's kids' kids. I mean, this is this type of change from a couple different positions, not like just play this out and then play a couple other positions out through the course of Travis's investment journey. And we could be talking about a delta between the two different of not doing something versus doing something, millions of dollars.
right,
Which your kids will realize with a step up and get to sell it tax-free.
right. Nick, I do have one question for you with what Christina asked though too, is what is the least amount of down payment you can get away with a rental in today's market? And I've never asked you that, but I certainly would have been interested in leveraging even more if possible.
Yeah, and I would say, yeah, there's options out there that you can get a lower rate with, especially if you're working with a smaller bank, right? Which is one thing I want to point out I'm learning a lot of, which is Wells Fargo's been great, but there's local banks out here with money to lend, and they'll actually have a relationship with you and let you buy properties with a line of credit or with 5% or 10%. Or now I'm not saying this is what you do, right? But I'm going to advocate for at least putting 20% down always. I think if you don't have that to put down in an investment property, right, I would check yourself a little bit and make sure that the numbers make sense. I think 20 to 25% should be, you know, a standard to abide by, to have some skin in the game, to have the money. Now, of course, if the numbers make sense, even with 5% down, yeah, because we just proved that being in the market, having a position is of a lot more value than having no position. In this case, having the money in the bank when inflation's at 7.9% in San Diego.
Okay.
All right, so.
And Nick, I'm sorry to interrupt one more time. Portia had asked a question a little while ago just about the maintenance costs that I just saw on there. And Portia, we took the actual maintenance costs in the 14 or 15 months that we've owned the Alabama properties and just divided it out over the number of months that we had owned it. So it wasn't something that we were necessarily accruing for. And a lot of those were actually to fix up the one particular piece of property that needed some paint and carpet. But that's where we got that. Other than that, you know, knock on wood, because all the properties, I think they are 4 years, 3 years, and now 1 year old. It's been pretty light on the maintenance end.
And I also want to mention, I didn't put any maintenance in the Mission Gorge, so it actually made Mission Gorge look even better.
Yep.
So Jill had a good question. What about capital gains on the SD property? If it's in an exchange, then does gains get paid eventually if the Alabama property is sold? Yes. If Travis were to sell out of his positions and unwind that, yes, he's going to pay taxes on that. Now, if Travis owns the property and is to then pass away and give it to his kids, the state of California no longer collects any form of taxes on that. And quite frankly, if your kids sell the position, there'll be a step up. So there won't be taxes from the federal government either. So in this case, this method is why you would continue to leverage, exchange, and be doing it for cash flow and wealth, right? For both. So you're not really getting out of positions unless it is to leverage up, or if you need money, then I would be looking more at a cash out refinance so that you maintain the position. So Travis, we've gone over a lot.
And I can 1031 again, right? Like,
correct.
When we decide we're done with these ones, or they need maintenance and we want to move out of them, we could continue this sort of indefinitely until it was passed on.
Yeah, absolutely. And that's,
okay.
We talked about that as far as the next step on your end for this portfolio would probably be looking to leverage into an apartment building, right, or something where it's got an economies of scale with one roof, one location, easier maintenance, management, and continue to step up also for the depreciation. So yeah, we've gone over a lot of stuff in a very short order here, but I really want to just dive into some of our ahas and takeaways from this and what we learned. Because I mean, both myself and Travis were, this was fun. It was a lot of work and a lot of analysis, but it was fun because these are conversations we have in our head, but we don't ever play them out on paper. So to get to play them out on paper and see it, real numbers, was awesome. And it helped to really learn a lot of things we may have debunked or thought were true, but aren't true. So, just going over what you learned, Travis, just speaking to kind of some of these points, what would you share with us as far as your experience?
I mean, I feel like it went really smoothly. We did, to be fair, we put a lot of time and energy into sort of the theory of what we were trying to do. We didn't just jump in with both feet, because I think it was probably about 3 months from when you and I had the first discussion about this until we'd listed Mission Gorge and decided to move forward and see how it might all play out. But really, the whole concept that it worked seems to work. I know it's been a really unique market over the last 15 months, but even in looking at what downsides could be or what might happen, I don't, if the economy gets bad, people are going to rent instead of buy, and if the economy gets good, people will be priced out and need to rent. So I still think my dad's language holds true on that piece, which is good or bad economy, there's still rents to be had. And I think being in a spot where we feel like we have a lot of control over what we need to do right now, we're at market rents. We've got the ability to be significantly under market rent, still be cash flow positive, and of course, continue to pay the principal down on those three. So we feel like we ended up with something that was a lot less risk, that actually had more appreciation and more cash flow. And that's usually a pretty tough combo to find.
Yes, and I'd say to piggyback on that, I think a few things I learned too is to make sure that you're looking at a snapshot as it pertains to current, but also looking from a bigger picture standpoint.
Yeah.
Right. Like I personally have, through the course of opportunities, recognized ones where I was too laser focused on what's the cash flow tomorrow, only to potentially lose sight of what the bigger opportunity was from that in a more of a 2, 5, 10-year play. Also just getting clear on kind of what are your investment objectives, right? Like, is it to create cash flow for retirement? Is it to create wealth for a legacy, for generational wealth? Is it to do both, right? I mean, just what is the overall objective you want to accomplish, and make sure you're working a plan that's consistent with that. And then the other thing I wanted to mention too is just Travis and I got into even more numbers, which I didn't want to throw on here, of using the income from those rentals, letting it accrue. And what we factored is if Travis just did nothing with the money from the 3 rentals, he would be able to buy another rental for $350 in 3.5 years. And then again, if you keep replicating that process, your timeline from the purchase to the next purchase continues to get smaller. So Travis, I know we didn't write it down, but off top, I mean, you mentioned something to me in an email about 20 years from now, like you would have accrued, what was it, 10 or more?
So I think 20 years from now, I think the idea would be if you just let it play, right, and you're letting your imagination go a little bit. There's not major periods without it being rented, but after that point, we would have amassed something like 17 properties, but we would be adding at least one every year that was purely paid for by the other rentals. So even when we played that out 25 years, and I know you went to 2052 on that other side, I think we ended up with, from an initial $50,000 investment, ended up with something like 25 properties, 200,000 a year in cash flow, and it funding the purchase of 2 additional properties every year all by itself. So something in the neighborhood of 9 to 10 million in property values, assuming no appreciation. So, I mean, I looked at this whole thing going, I can't count on appreciation, but I can count on cash flow. So assuming 0 appreciation, you're talking about $9 million in property. You use the appreciation numbers you had, and you're probably talking about $50 million in residential property 30 years from now from a $55,000 initial investment. And being smart, talking to people like you, getting introduced to the right people, and being able to be reasonably active in the decision making, but very hands off in the actual management of the investment.
Or you could just keep the condo. I mean, it's up to you, right?
And that would be good. the kids would not complain about a $2 million condo 30 years from now, but I think they'd be a lot happier with $50 million of a real estate portfolio.
I would probably agree with that. Yes, that makes sense. Real quick, Jeremy had a question. What are the limitations of, if any, on buying a property less expensive than the one you're selling? So you can do that. It's called a partial exchange. You're just going to pay boot or taxes on the delta or the difference between what you sell for and what you buy for. So Jeremy, if you bought, you sold a 500,000 and bought a 400,000, you can do that. You're just going to pay tax on the $100,000 difference. So outside of that, let us know if you guys have any other questions on this. We'll certainly follow up with the slides, the call, as well as any other information that you might be looking for. And I guess in closing, anything else that you wanted to add, Travis?
No, I think we nailed it down. I mean, thank you. This has been a really interesting year, and I'm really glad we were able to get everything kind of back together and down and on paper.
Yeah, thank you for taking time out of your crazy schedule. We appreciate you dropping some insights and knowledge and kind of letting people see from reveal the curtain of, hey, here's what we did, here's what my situation is. So thanks for letting us delve into your personal and financial investments and get to learn and have a successful investment career ahead for everyone here on the call. So thanks for joining us, guys. Yeah, I hope you got a lot out of this call. Look forward to our next call next month, and feel free to shoot us an email, call me if you have any questions. Have an awesome rest of the week. Cheers.
Bye, Nick. Bye, Portia. Bye, everybody.
Bye, everyone.